Good morning, everyone. Welcome to Flyers Real Estate, Direct Lending and Private Debt Forum, Part 2. This is day 2 of our event. This is our 4th event in the series. Part 5 will be on July 16th in New York City, conditions permitting. We would like to thank our sponsors, Nationwide, Prequin, Boomerang Capital, S&P Global Market Intelligence, Safe Harbor Equity, the Mortgage Office, Harvest Volatility Management, Millennium Trust, Apex One Investment Partners, Intrust Global, Off the Chain Capital, and Clarion Asset Management for making this event possible. We had a great day 1, and we're certainly expecting to have a great day 2 today. Also, we'd like to thank all of our Flyer members and the Flyer board for their support during these challenging times. For those of you that are not familiar with Flyer, Flyer is a 501c6 nonprofit organization started in 2007 with the goal to become the world's leading marketplace for alternative investments and alternative investment education. Since then, Flyer has helped thousands of firms in the capital raising process, aided in the allocations of billions of dollars to alternative investments, and we've leveraged technology to accelerate the due diligence process. Today, Flyer has over 1,000 members with over $1 trillion in discretionary AUM. Thank you for joining us today, and I hope you enjoy today. Our first presenter today is Mr. Nick Rojo, President and co-founder of Affiliated Development. Nick?
Thank you, Rainford, and thank you, Mike. Appreciate the opportunity to present today. I'm excited to be here. Hopefully you all can see my screen here. Like you said, my name is Nick Rojo. I'm with Affiliated Development. I'm going to talk to you about our company and how we're working to address the workforce housing crisis, as well as discuss our newly launched impact investment fund. All right, so we are a South Florida-based real estate development and investment company. Our core strategy is really to build mixed-use multifamily projects, and we target unmet demand and underserved areas within the market. In doing so, we work very closely with local government and communities on incentive programs so we can bridge the gap and bring our projects to life. That's really our core strategy, is to leverage local incentives. And in some instances, we even create our own incentive programs to develop Class A housing at attainable rents. Although we've done projects throughout the Midwest, we are South Florida based and now solely focused on the Florida market. The Florida market happens to be ground zero for the workforce housing crisis. So we kind of use some of the methods we learned throughout the Midwest and apply them to South Florida. What is workforce housing? There are a lot of terms you hear thrown around in the housing business. You hear affordable housing, you hear attainable housing, and you hear workforce housing, and you often hear them used interchangeably. The way we view workforce housing is consistent with what's in the Florida statute, which means households that earn between 80% and 140% of the area median income. HUD publishes annual rent income and rent limits and sets the area median income for every county throughout the country. Traditionally, affordable housing is where developers target the lower end of the spectrum, which is 60% of area median income, and they're able to access low-income housing tax credits to get the projects off the ground. What makes a workforce very difficult to develop is the fact that there are no substantive state or federal programs such as low-income housing tax credits to help address workforce housing. We have to figure this out on a local level. For example, if you look at Palm Beach County, the median income is $79,100. If you are a two-person household making $56,000, you would fall under the 80% of AMI category. And the most I can charge for a one-bedroom is $1,318 if I'm using a program that requires me to rent to people in that income range. So all the programs that we access typically are using, and all housing policy typically uses these set-asides from HUD in order to set income and rent limits for any kind of restricted property. So Florida is really ground zero for the workforce housing crisis. 4 out of the 5 top 10 markets for cost burden renters are in Florida. Now, a cost burden renter is someone who pays more than 30% of their income in rent. So if you look at this map here, you see the orange. The orange is basically the cost per renters, and you'll see the Tri-County area of Dade, Broward, and Palm Beach, which is South Florida, all orange. So basically, rents are obviously higher in New York, Chicago, LA. However, they have higher incomes to substantiate those rents. Here in Florida, rent inflation has outpaced incomes. So, we've quantified that there's over 500,000 households just in this Tri-County area that are cost burdened. One of the consequences of growth and development that's occurred in some of these metro areas is, middle and lower income tenants get pushed out to the suburbs and have to commute long distances. That they're working in job centers in metro areas, and according to FDOT, which is Florida Department of Transportation, they're commuting about 30 minutes a day to work. So, one of our kind of acquisition criteria when we're looking at sites is we need to be in their job centers to help alleviate that. So workforce, obviously, like I mentioned, is very difficult to develop. Land prices are what they are, building materials are what they are. So investors typically utilize more of an acquisitions model and a value add strategy where they buy C property and convert it to B property in order to target the workforce renters. We've had differentiated ourselves by actually building the Class A standards and actually developing new projects and offering them at attainable rents. The way we do this is by utilizing gap funding. So when we underwrite a deal, first thing we do is we identify where the gap is and figure out how to plug it. We have to utilize conventional equity and access to debt capital markets, just like a developer is developing a high-end condo or a market rate apartment building. And our investors can choose to invest in our project or the market rate project up the street. So we have to provide a return and use underwriting standards that are consistent with the market. In other words, we don't lower our underwriting criteria or underwriting standards just because we're building to workforce rents. We field a lot of questions regarding the scalability of our model, given our reliance on local incentives, and pulling these incentives together is very, very difficult and time consuming. But I can tell you, we have a lot of arrows in our quiver. And to date, my partner and I have raised over $100 million of local incentives for new development projects. So I want to go over quickly some of our projects that we've done and kind of walk you through how we finance them. The project that is up here now really set the stage for our core strategy. It was executed in the height of the global financial crisis. And that was a time, as you know, where banks weren't lending and investors weren't investing. So we had to get very creative. We proposed a rental tower that was 30 stories, had over 200 apartments and 14 condos. So like I said, we had to get very creative because there was no capital to access to get this project off the ground. And in particular, the site in Milwaukee where this project is located had seen very little investment, but the city really wanted to see the area redeveloped. So what we did was we went to the only lender that was in the market, which was HUD, and utilized a 221D4 loan. One of the reasons we were successful in getting the loan done was because the AFL-CIO was our Ginnie Mae investor on the securities for the D4. This was a time when unemployment in union trades was north of 30%, and we could put a lot of their people back to work, and they realized that. We then went to the city for a $9.3 million TIF. TIF stands for tax incremental financing, where we're essentially capturing the future tax revenue that our project's going to create. Before we put a shovel in the dirt, we just had an empty lot that was generating very little tax revenue. So, when we showed a $65+ million project, obviously this is going to substantially increase the tax base, and we were able to monetize some of those tax increases. This TIF really bridged the gap for us and allowed us to commence construction. So the end result was, the city saw new development in an area that had been blighted, and we put a lot of good people back to work. So we quickly realized that we could work with local government to solve a need, whether that need is workforce housing or the need is for new development in an area that had been underserved. So this next project I want to go over is called Emerald Row. It's in Oak Creek, Wisconsin. Um, what happened here was Northwestern Mutual was relocating some employees to the area, and the housing stock was not sufficient to house all those employees. It was all old, 70s style. So the issue was there was really no established market for us to justify a new development. So again, we got creative. We got with the city. We used a TIF to plug the gap. And we were able to develop 167 units. It's now stabilized, it's fully occupied, and phase 2 is underway. This next project is actually an affordable housing project. It's called St. Johns Plaza. It's located in downtown Miami in an area called Overtown. We partnered with a nonprofit on this deal, we utilized low-income housing tax credits, as well as several other incentives to develop 90 units of affordable housing. This area was very, very blighted. And when we first started working on this deal, it's not a place where we felt comfortable walking around. So it's interesting what happened over the next several years. The Brightline station came in downtown Miami, right by the on 3rd and 13th there, right by the building. And now we feel safe walking around, and the area is completely transformed. This was a very, very complicated deal, several funding sources. As a company, we don't really focus on tax credit business, but this transaction really helped us hone in and figure out some of the other funding programs and incentives that we can use to develop workforce housing. This next deal, which we've recently starting to deliver, actually, it's in lease up, is a 142 unit mixed use project in downtown Fort Lauderdale. We received a $7 million grant from the city of Fort Lauderdale, and in return, we've restricted 100% of the units to workforce rents. Fort Lauderdale is, again, it's at the epicenter of the workforce housing crisis, so there are literally thousands and thousands of tenants out there that are looking for something just like this. And as you can see, we build the Class A standards. This building has co-working space, a gym, you see the elevated pool deck there in the picture, dog walk park, all the amenities that any other Class A building would have. However, getting that $7 million grant has allowed us to lower our rents to a point where workforce renters can afford to live there. Additionally, another noteworthy aspect of this deal is, shortly after tax reform was passed in 2017, we were still in the pre-development process on this project, and we realized that we were actually in a qualified opportunity zone. So subsequently, we were one of the first developers to utilize the qualified opportunity zone program, and all our investors were all family offices with large gains exposure. Another thing I want to mention about this is this project really speaks to the resilience of workforce housing. As I mentioned, we're currently in lease up, and we're in one of the hottest multifamily markets in terms of Flagler Village. There's hundreds and hundreds of units in this direct vicinity that are in lease up right now. So we have a lot of competition. They're pretty stagnant right now, given where the market is. We are signing leases every single day. So there's a tremendous amount of demand for this type of product in the area. So the next project I want to go over is the Mid. This is a 230 unit deal. It's in Lake Worth Beach, Florida. Lake Worth Beach is a kind of a suburb of West Palm and Delray, kind of in between the two. This is more of a garden style product. You'll notice it's surface park. So the construction costs, obviously, on a project like this are substantially less than the 613, which is a mid-rise with structured parking. So in turn, we need less gap funding in order to get the project off the ground and offer attainable rents to our tenants. So we were able to get some grants and some subsidies from the city of Lake Worth Beach and their CRA. And something interesting about this project, we're using tunnel form construction, and this project, we went vertical on January 1st. So we started the first of the year, and we're about to top out the entire project. So, Moss Constructions, I'll give them a shout out. They're a general contractor. They're doing a great job on this project. We're really excited to deliver it because you could literally save $1,000 a month living here and only commute 5 to 7 minutes north or south and be at job centers. So, we're really excited about this deal. This next project is actually in pre-development. It's the reason why I want to talk about it is because this project's going to be in our next fund. We're really excited about it. It's a big project, and it's right in downtown West Palm Beach. This is a true mixed income project. So we went to the city of West Palm Beach about a year and a half ago with the idea for this project. And we came up with a funding package, and we were approved for over $15 million of incentives. The way this deal works is we have people at various income levels from 80 to 140% of AMI for 66% of the units. The other third of the building is essentially unrestricted, so it's market. So we're going to have people of all income levels living together in this building. We're really, like I said, we're really excited about this because our blended rents are substantially less than all the Class A inventory in the area, and we're offering the same features and amenities as they are. And just, I want to highlight too the location, because location is obviously very, very important in our business. And as a company, we want to make sure that we are adjacent to job centers, especially because we're developing workforce housing. And this site really checks all the boxes for us. We are literally right behind the county courthouse, which is one of the largest employers in the area. We are a block from the West Palm Beach Police Station. You can walk to City Hall. You have the Brightline train station there you can walk to. If anyone's familiar with the Brightline, it's a commuter rail system. We love it. It's great. You can take it to Miami in an hour or Fort Lauderdale in half an hour. It's nice, it's safe, it's clean. And we have downtown Clematis here with all the shops and restaurants. So this site is really, really walkable. And it can really cut down on traffic congestion, because if you stand on the corner of this site at 5 o'clock, what you see is hundreds of people leaving downtown West Palm. Those people are going to Wellington and Royal Palm, and they're going out west just because the housing is cheaper. I know there's a local school in the area where a lot of the teachers live in Port St. Lucie. Port St. Lucie is an hour away. So they're commuting an hour every day because they've been priced out of this market. So we're able to deliver, a project at rents they can afford, and they're not going to have to commute out. And the city is going to allow them to stay in town, spend their money locally, and build their tax base. So it's kind of a win-win for everybody. Now, there's a lot of buzzwords in the investment world today. You hear ESG, impact, SRI, and we feel that what we do is really a double bottom line investment that fulfills our core mission of doing good while doing well. In terms of ESG, we build to national green building standards. You look at SRI, we deploy a lot of social programs that are building to drive tenant satisfaction, and that really makes them sticky tenants. For example, teachers will lower their rent so they can teach after-school programs, and that really creates a sense of community that we're going after. And from an impact perspective, we're obviously providing safe, clean, and attainably priced housing that otherwise people would not have the opportunity to live in. We also, one big thing we do is we offer a first look program to local police and fire and other essential employees to allow them to have first look at units in our buildings that often have waiting lists. I'd be remiss if I didn't discuss COVID. As I mentioned, we're in lease up on 613, and things are going very well. Part of the reason is, the strong demand for this with, 60% of tenants in the area being cost burden. And not only that, the markets have been pretty resilient down here. Rent collections on Class A are pretty strong. And, just looking at our lease up, we feel that we'll be leased up in no time. So before COVID, there were 300,000 people a year moving to Florida. And that number, I think, is certainly going to increase. So we're going to see a lot of migration in the area. And, as these companies move down, obviously they bring their employees with them, clerical employees and members of the workforce. We also feel that the current market's going to present some opportunities for us. we're already seeing deflation in terms of labor and material costs, which is great because the less we have to pay to construct these projects, the less gap funding we need, and the easier it is for us to get these buildings off the ground. And one of our biggest hurdles in South Florida is finding a reasonably priced land. And we're starting to see land sellers kind of come to life a little bit because, before COVID, it was very difficult to make deals with people because they obviously had stars in their eyes because the market was going crazy. So now I want to talk a little bit about our fund and why we're doing it and our investment criteria. So we have a pipeline of workforce housing projects currently right now that roughly encompass about $100 million worth of equity. We're going to have definitely a box around what we can invest in. Obviously, location, as I mentioned, is very important. We're going to go target high-cost areas with significant barriers of entry. We're going to be near employment centers. And obviously, very important, we're offering workforce housing, so there needs to be a rent differential, meaning we need to provide a meaningful rent discount to comparable project in the local market. And as I've alluded to before, these projects need to underwrite comparable to any other apartment deal. So we're going to have a minimum development yield and IRR standards. As I said, we're raising $100 million up to $125 million. It's a 7-year term. GP commitment's 5%. It's going to be an 80-20 deal with a 7% pref. So just a summary overview. We feel that obviously this is a very defensive investment in workforce housing. We're offering comparable product to the market at lower rents. I touched on the impact aspect of the investment. And, down here, I have a little chart that shows our pipeline. As I mentioned, we do have a pipeline of projects that are in various stages of the pre-development process. The project I showed you before in West Palm is approved. We have a project in Lake Worth, another project in Lake Worth that's approved. And then we have projects that are just in the pipeline. So if you look at the totality of our pipeline, we could very easily put out $100 million over the next 3 years. I just want to, briefly, before I take questions, go over kind of how we're structured. All our development and asset management is conducted on site and in-house. We outsource property management, we outsource design, and we outsource construction. We know what we're good at. We're very focused on what we do. Like I said, it's a lot of work to, get the gap funding together to get these projects off the ground. So we're very focused on the development, asset management, investment management process, and we let the design and construction professionals handle design and construction. So with that said, I'll take any questions. I have one question that says, why isn't everybody else doing this? And then that's a question we get a lot, actually. So, it's hard, so to speak. So, doing these deals, it takes a lot of energy and work on the front end. So the way we operate is we will not move forward with a site and put down hard deposits until we feel good that we've secured the gap funding we need. So again, we're out there, meeting with public officials and doing a lot of work, even before the real work begins of, going out there and getting our entitlements, getting our approvals, getting the building built, getting the building constructed. It's a lot of work. So a lot of the market rate guys do what they do best. They focus on market rate. The tax credit guys do what they do best. They focus on tax credit. And this is just kind of our niche in our space that we operate in. Another question is, what is the investment length? So typically, I'll take the 613, for example. We closed on the property. We closed on the investment in April of 2019. And we were expecting to refinance and return a significant portion of the investor's money in the next 6 months. So, it varies on how many units we're doing. And that deal just happens to be a 10-year hold. The fund's not going to be a 10-year fund. Typically we can develop and sell a deal, in 3 to 4 years, but we prefer honestly to refinance and hold on to these assets, especially if we're generating a nice cash on cash return. So another question, do your developments have something akin to an HOA? No, we don't have an HOA. We're just a standard rental project where you pay your rent. Another question, what services are available to renters that are likely to be working from home during and post-COVID? That's a great question. So one thing we do in our buildings is we provide co-working spaces. And one of the reasons we provide co-working spaces is because a lot of people rent a 1-bedroom with a den because they work from home, or they rent a 2-bedroom and convert it to an office. So what we do is we typically, we create these co-working spaces, and obviously now we'll have, hand washing stations and sanitizing stations and require masks, but you're going to be able to have little offices, little conference rooms, areas you can plug in and not have to spend money on space you don't need. This is a really good question. How long are the affordability restrictions on projects with public subsidy? Very good question. So the answer is it varies. So in the tax credit business, you're going to be deed restricted for over 30 years. In our business, it varies. On some deals, we have no restrictions, where the city just wants to see new development. So the mid, for example, which I showed you in Lake Worth Beach, has no restrictions at all. On the 613, it was in downtown. The city really wanted workforce housing, so we signed a 10-year deed restriction. So the answer is it depends on your funding source. Your funding source will dictate what your restrictions are and how long they are. Another question is, do you target opportunity zones? Look, we don't let the tail wag the dog. We see a lot of people do deals just because they're in a qualified opportunity zone. If it's in a QOZ, great. We don't necessarily target them. I mean, yeah, they're great. There's a ton of equity, ton of capital out there. Our fund is not targeted to QOZs. Especially because we have a 7-year time horizon on the fund, and you have to hold for 10 years on a QOZ to get all the benefits. But yeah, obviously, yeah, it's great. Like I said, there's a lot of capital out there chasing those deals. So if we find one, great. If we don't, whatever, we're not disappointed. Another question, is the fund acquire land with entitlements, site approval plan? Yeah, so typically, we'll go out and get all the gap funding, get our entitlements, and then we'll contribute it to the fund. So the fund's not taking that risk. And I think that's all the questions.
So Nick, thank you very much for your presentation today. You did a fantastic job on it. It's really interesting the way that you structure and put these deals together. Will we be able to provide people that requested your presentation a copy of the presentation, or how would you like them to go about getting in touch with you?
Yeah, sure. They could email me at nrojo, NROJO, @affiliateddevelopment.com. So they'll feel free to email me or get in touch with me through you, and we'll take it from there.
All right, that's great. Thank you very much for your time today. We wish you the best luck with these projects. They're really interesting, and we love the way that you actually structure them. Have a great day, Nick.
Thank you.